As of Monday, the average 2-year fixed mortgage rate for UK residential property buyers surged to 6.01%, marking the highest level since December 2022. This data comes from the primary borrowing statistic for the housing market according to real estate information source Money Facts. The rate stood at 5.98% on Friday. Additionally, the 5-year mortgage rate experienced an increase, climbing from 5.62% to 5.67%. The consequence of this upward trend is a reduction in the availability of home mortgage offers. On Monday, there was only 4,683 goods available, which decreased from 4,923 on the previous Friday. Recent dates have witnessed a significant surge in mortgage rates across the United Kingdom, anticipating the Bank of England's predicted interest rate hike later this week to combat surging inflation. The Fed is expected to raise borrowing cost for the 13th consecutive time on Thursday. If you haven't already, kindly consider subscribing to our channel and hitting the notification bell, ensuring you never miss any updates or exciting content we bring your way. Unfortunately, more than a quarter of UK homeowners with fixed-rate mortgages are likely to encounter a drastic spike in their monthly payments once their current terms expire in May. The Bank of England made an announcement stating that a staggering 1.3 million fixed-rate mortgages would mature before the conclusion of 2023, and an even larger number is expected to come up for renewal in 2024. Martin Stewart, the director of Mortgage Advisory London Money, expressed his concerns, labeling the market as dysfunctional and possibly broken. He disclosed to CNBC that mortgage advisors have been witnessing an unprecedented scenario with long queues, comprising around 2,000 individuals, all vying to secure something that may or may not be available by the time they reach the front. According to this industry expert, the past 9 months have been nothing short of seismic for the mortgage and housing sectors, drawing comparisons to the impact of the financial crisis or beer for different reasons. What are the current interest rates for mortgages today? On the 20th of July, 2023, the average mortgage rates in the UK are as follows. The average 2-year fixed rate mortgage rate in the UK is 6.81% based on 75% loan to value. The average 5-year fixed rate mortgage rate in the UK is 6.3% based on 75% loan to value. The average 2-year variable rate mortgage rate in the UK is 5.59% based on 75% loan to value. The average standard variable rate SVR in the UK is 8.4%. Keep in mind that these are just the average rates for different mortgage products available in the market today. They might not necessarily be the rates you get, as it depends on factors like the type of mortgage you choose, your financial situation, and the amount of deposit you have. If you have a larger deposit, you'll usually get a lower loan to value ratio, which often means access to lower interest rates. Remember, the rates can also vary depending on the type of mortgage product. Fixed rate mortgages might have higher initial rates, but they stay the same throughout the deal's duration. On the other hand, variable rate mortgages can start out cheaper but may increase over time during your deal. Given the ever-changing mortgage market, rates can fluctuate frequently. To find the best mortgage rates available to you, it's a good idea to speak with a whole-of-market mortgage broker who can compare deals and help you find the most suitable option. Will interest rates rise or fall? Some experts predict that the base rate in the UK could drop as low as 3% by the end of 2026 after the 2022 odd-or mini-budget. UK mortgage rates have generally fallen from their dramatic heights, but individual rates have still fluctuated depending on how changes in the base rate have affected them. In response to rising inflation, the Bank of England has increased the base rate 13 times in a row, with the most recent rise occurring on 22nd of June 2023, bringing it up to 5%. The bank's Monetary Policy Committee is scheduled to make their next decision on the base rate on 3rd of August 2023. As for the potential height of interest rates, historically the highest recorded base rate was 177% back in 1979. However, it's not currently expected to reach such levels anytime soon. Most analysts anticipate the base rate to be around 6.5% by the end of 2023 or mid-2024, but this could change depending on economic conditions. Keeping track of current mortgage news will help you stay informed about rate changes. It's essential to understand that not all mortgage rates will necessarily increase. When the base rate rises, tracker mortgages are directly linked to the base rate, so they'll always be affected by changes. On the other hand, fixed rate mortgages usually have a delayed response to base rate fluctuations, since lenders consider estimated rises in advance. If you're concerned about your interest rate rising, there are some actions you can take. You may want to consider fixing your mortgage, which will keep your rate the same for a set period. But do check for any early repayment charges if your current deal hasn't ended yet. Alternatively, if you're due to remortgage within the next 6 months, you can lock in a new rate now and switch when your deal ends, avoiding any early repayment charges. And if rates fall before your deal ends, you can switch again to get a better option. On the other hand, if you're worried about missing out on the benefits of lower rates, you could opt for a shorter term fixed rate mortgage, which means you're locked into that rate for less time and makes it easier to switch when rates fall. Another option is considering a variable rate mortgage like a tracker deal, which will immediately benefit from a fall in the base rate. Keep in mind, though, that it works both ways, so if rates rise, you'll end up with higher monthly repayments. Pepper Advantage, a global credit intelligence provider, recently released data on its vast portfolio of over 100,000 UK residential mortgages. The findings revealed a worrisome trend, showing an 11% increase in the percentage of residential mortgages in AAR during the year leading up to April 2023. This growth rate is the highest since the global financial crisis, raising concerns about borrower stress. The rise in mortgage ARAs aligns with Pepper Advantage's data on repayment collection failures, also known as direct debit rejections (DDRs). These occur when a direct debit instruction is processed by a creditor, but the borrower's account lacks sufficient funds. In the year leading up to April 2023, the company witnessed a significant 33% rise in the percentage of accounts with a DDR across its UK portfolio. Historically, DDRs have acted as a leading indicator of borrower distress, and the increase in DDRs foreshadows an acceleration in mortgage ARAs. Pepper Advantage's data illustrated an upward trend in its DDR rate throughout 2022 and into the first quarter of 2023, with a notable spike in January. This increase in January is typically as it follows the holiday season. However, the peak in January 2023 marked an all-time high. The data also highlighted regional and product variations. The ARA rate for fixed rate mortgages rose by 35.7%, while for variable rate mortgages it increased by 25.1%. However, the variable rate mortgages had a higher base for growth. Interestingly, approximately 1 in 5 variable rate mortgage borrowers in Pepper Advantage portfolio experienced at least one delinquent payment in the 5 months leading up to April 2023. Another significant finding is a clear north-south divide in the UK. The northeast and northwest regions exhibited higher percentages of arranged by, with each region having an ARAS rate of approximately 10%. In contrast, London had a lower ARAS rate of around 5%. Furthermore, the data revealed that borrowers of all age groups are facing financial strain, with younger age groups experiencing the highest growth in AAR. Borrowers aged 21 to 30 saw a 50% increase in AERS, while those aged 31 to 40 experienced a 42% rise. Pepper Advantage leverages the insights derived from its mortgage portfolio data to identify areas of borrower stress and develop tailored solutions for its clients. These solutions may include arrangements for concessional payments, term extensions, interest rate reductions, short-term interest-only periods, and payment holidays. Jerry McHugh, CEO of Pepper Advantage UK, emphasized that while signs of financial stress may appear diluted when looking at borrowers in general, focusing on specific segments reveals feel a different and concerning Picture the real-time granularity of this credit data enables them to collaborate with their clients effectively and provide the best assistance to borrowers during challenging times. If you haven't already done so, please consider subscribing to our channel and activating the notification bell to ensure you never miss out on any changes or new stuff we bring your way. Your engagement and support mean everything to us. Please share your ideas, opinions, and questions in the comments box below. Your opinion is important to us and we appreciate the insights you bring to the table.